Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your agriculture update, and this is for a wild trading day on Tuesday, the 23rd of October, 2018, and we're just about 4:05 p.m. Central Daylight Time. You would not know the action in the stock market by looking at the close, down 11 in the Russell, 15 in the NASDAQ, Dow down 50, S&P down 10. But if you look at the day's lows and you see how much stretched out this market was, you would. The beans were down a little bit today as everything else was very, very stable. There wasn't a lot of action one way or the other. I think the traders were so much looking, and I was on the trading floor doing TV shows, looking at what's going on. They were just mesmerized at the big swings going on. When we look at a weekly area chart of closes on the soybeans, the market is doing its darn best to stay over the red line, which is the 18-week moving average of closes. For the week, you're up 3/4 of a cent. So when I'm saying it's quiet, it's quiet. In the beans and the Jan beans, you were down 1.5 pennies today, and you can see how the market's been gradually leaking itself down. The pattern is still bearish on this part of it. You still have lower highs, lower lows, but it's a grudging break. It's not just letting go. It's today 1.25 pennies, the day before. If you look at yesterday, market up 2 cents. If you go to the day before, the market down 7. So it's sort of running out of steam since this big break occurred. That doesn't mean it can't pick up steam, it just hasn't. Unlike the weekly chart, the daily charts are under the 18-day average of closes and the 100-day. If the market rallies, I'd look for the first resistance at 878 3/4. Let's call it 879, right that area. If it can get through there, maybe it can get to the 100-day average of 890, but you'd have to take out 904 in the current pattern to change it from being bearish. The Bollinger Bands are even higher than that, 902. So to get to that 904, you got to go through a lot of layers of resistance, and I think that's what the chartists are looking at. In terms of market momentum, you've entered an oversold condition. Why? Because I view, this is just me, I view any reading under 30 in the slow stochastic as being in an oversold territory. So I have a market that's in a downtrend with downside bias, momentum down, oversold at this point, sort of running out of momentum. If the market can get another leg to it, maybe you can get to that 855 level. If it's running out of downside momentum, 18-day average could be the resistance. The story's very similar in the meal. You've gone from the upper Bollinger Band way up here, as you can see. Can you get to that lower band in an oversold condition that is not trending? In this, you have the lower low, higher high pattern. So you got bias down, momentum down, but oversold. Can you reach for that number, or does the market start coming back up and maybe finding resistance at 316 1/4? When I come to the December soybean oil, if you look at the day's low, it was 28.72. The Bollinger Bands, 28.71 in an oversold condition with the trend down. I think the pros took money off the table within that point. Maybe they didn't, but that's where I think they're trying to. Resistance now back at the 100-day average and then the 18-day average of closes. The corn market, and I think I've mentioned this before, it seems to be caught between the 100-day average and the 18. The range for the day, 4 cents. So you've lost the volatility in the market, and when you lose volatility, what starts happening are Bollinger Bands via the formula start going sideways, the black dashed lines, and the market starts getting itself contained within those bands until they narrow in enough and they sort of squish everything down to the point where volatility can come back on a breakout one way or the other. Wheat's in that same pattern. You can see it even better here, and you see how the market tried to break out to the upside, failed, came down. Now is it hitting the lower Bollinger Band? Today's low 505 1/4, the Bollinger Band 504 3/4. You're oversold. This could be a support area, but certainly not a change of trend area. In the sugar, We have stalled out with the embedded reading. Now remember, the embedded reading means that you've converted a market where both numbers that make up the oscillator called the slow stochastic, and they both go over, in this case, 80. And they do it for several days minimum, and that keeps the market in a buy mode until the red line gets back under 80. In the coffee market, the market lost that embedded reading yesterday, did not gain it back today. So I am going to look at this area where the market's playing back and forth for opportunities where I think the market's going to fail in this area and try to get back to that 18-day average of closes. It's also come off of a heck of a run to the upside. Is the market a sale? I don't talk about that. Or buys? I don't talk. I just say what I think the pros are doing. In the cocoa market, you have a pattern of higher lows, higher highs, overbought. So far, I haven't been able to reach up at all to that upper Bollinger Band for a very long period of time. I have to go back to August to see that. So as much as it's come up, which is a lot, the market hasn't had that extra oomph that I'd like to see, and it's now in overbought territory. Cotton market got stymied 2 days in a row at the upper Bollinger Band. I'd look for support back at the 18-day average. However, I think the pros will be very, very nervous about buying too much there because you're overbought in the market. You got to work that off, I would think, for them to be more comfortable. In the cattle market, you still have the pattern in the swing line of higher lows and higher highs. The price today, you closed 117.15 under the 18-day average. When the two fight each other, in other words, the bias is down because you're under the 18-day average, yet the swing line's up, I call the market neutral. Momentum has gone neutral as well. In the feeder cattle market, you have a pattern of what here? You've got a lower low and a higher high. That is not a trend. The support in the market's back at the 100-day average. The momentum was lost on the downside. I am still, the word is still, looking for price and the 18-day average to come together in this market. In the hog market, we're hearing more and more cases of the swine flu coming out of China. We heard that somebody tried to take some sausage, pork sausage, into Japan. They caught it. They tested it, and lo and behold, swine flu in it. And yes, it could be spread in many ways. What if an animal ate that? So you don't know where you're at with it, but higher high, lower low, not a trend. Market got under that 100-day average and used the lower Bollinger Band as support. This is the first move back over that 100-day average. Can it reach the 18 is going to be the question. You know, a way that I teach people to look in these markets is sometime with seasonal trades. Now, the limitation on seasonal trades, and let me explain that, is that you're assuming that past history is telling you what the future will do. There are great limitations to that. Great. But one of the things I do look for is, gee, it's harvest time. What are the odds at this time of the year that harvest you put in a low with the market? Or what about getting into year end? Should the stock market start rallying or not? Different ideas at different times, and they also write articles about this. So what they do is they'll give you a date to get in, date to get out of the market, what the average gain has been, and they only show trades that have worked, at least. Out of the past 15 years, I think it's 13 of the times. I don't know if it's 12 or 13, but it's right in there. If it doesn't, the trade is dropped. If you'd like a free trial to this, you can get it through us by calling my staff, or if you go to our website and sign up for your free offer, you'll see a carousel of free offers. Click this on, we'll send you the link for your 2-week trial. You can also click up here. I've been using this service for decades, so it's something that I look at because I like to know what those seasonals are. I will share this with you. The one thing you don't do is use the seasonal on its own. You've got to have it as part of an arsenal, not a standalone. I really believe that. You have a good day.